Hello everyone, welcome to Mr. Kop's channel and our today's topic is provisions. Provisions is covered under IAS37 and IAS37 also covers contingent liability and contingent asset. But our today's video will be around provisions and on contingent liability. So there is a brief introduction about me. You can go through it. It talks about my background, experience, skill sets, qualifications. So before we understand provision, let's understand what is a liability because provision is itself a liability. So what is a liability? So we'll break it down, the liability into three different parts. So first part is an outflow of economic resources, outflow of economic resources. I will mention all the keywords with capital letters, okay? Economic resources, which arising as a result of a past event, okay? Arising as a result of a past event, okay? Further, the outflow has to be measured reliably, okay? Now, furthermore, it has to be probable, okay? So these three things has to be there: measured reliably, probable, and an economic outflow of economic resources arising as a result of a past event. So this all these makes liability a present obligation. What is it? A present obligation. It is a present obligation. Okay. So this is liability and provision is type of liability. Now let's dive into what is a provision then. So we have listed down the pointers for provisions. So we'll see to it if we have, after covering the topic, if we have missed out on provisions or any points. So this is what we have recorded. So the three things about provisions. Okay. So let's just go through this once. What it says. So I-37 defines and specifies the account for and disclosure of provisions. So we need to account and disclose the provisions. Okay. And okay, just see it is and it has to be accounting for and disclosure of provision required. Contingent liability and contingent asset. So contingent liability just requires a disclosure. Provisions require accounting. Okay. Provisions require accounting. Okay, so we just talked about liability, outflow of economic resources, measured reliably and probable. Okay, now what is provision? Provision is a liability of uncertain timing or amount. So liability is something which we are certain, okay, I need to pay this much at this point in time. But if there is a mix of uncertainty, okay, not a highly uncertain, but probable, but a little uncertainty is there. Probable means greater than 50%. If the probability is greater than 50%, it can be considered as probable, okay? Greater than 50% probability can be considered as probable, okay? So now, what are the reasons due to which this provisions arise or a liability arise? So a liability or provision arises due to commitments, due to promises made either by law, by legislation, that is a legal obligation, okay, a legal obligation or a constructive obligation. So legal is straightforward by law. Constructive is something which the company has been practicing for the past years, or the company has publicly made a promise, okay, that I will do so and so stuff, and then because of that there is expectations on the other side, on the public side or on the other stakeholders side, that you will deliver this. Okay, so that becomes a constructive obligation. Constructive obligations example could be that a company promises that it will keep its surrounding clean. Okay. Or in the area in which the company's factory operates, it will make sure there is no environmental damages caused. Okay. So company has becomes liable for that now, because it needs to make spend expenditures with regards to that to make sure that the environment is clean, so that becomes a liability. Okay, a sort of provision has to be created for that liability. Okay. So yeah, so now we will see like provision, how it can be measured, how to measure provisions based on different conditions, and how subsequently it has to be treated. Okay, so let's create some room here. So first we will talk about the initial recognition. So initial recognition, or we can simply mention it as measurement. Okay, so the first thing is the best estimate. Okay, simple way, best estimate. Now, what is a best estimate? Now, best estimate is, say, there's a possibility of two things happening. Okay, okay, this can be, say, a legal case, a legal case. Two things happening: either you win the case or you lose the case. If you win the case, nothing, you don't have to pay anything. But if you lose the case, okay, you have to pay, say, $1,000. Okay, $1,000. Okay, now we need to see if this amount the scenario of losing the case is probable. If it is probable, then this estimate of 100K is reliably measured. If it is reliably measured and it is probable, and this is happening because of something the company has done in the past which was not correct, and it gives rise to a present obligation, then this has to be recorded, okay, as a provision for legal case. So this is one thing. Now the next could be, let's take the correct font. Uh, Second could be the famous expected value. Now in the previous scenario, we saw that there is only two possible outcomes. Okay, either this or this. But if there is a possibility of having of happening of two or more outcomes, okay, all can happen simultaneously. So this can happen in a case of, say, warranty. Okay. Now, companies sell their products on warranty, right? Now, warranty against physical damage, software repair, or all stuffs like that. Now, if the company has sold X amount of goods, then there is a chances then Y amount would come, Y amount of its product could come back for repair, where there is a major cost needs to be incurred by the company. Another set of goods can return where there's a minor. Okay, so both the outcomes are possible. Okay, so based on historic records and some best guess judgment and analysis, the company will sign, say, okay, for major damages, 80 5% of the goods will come, and the possibility of this is say 50% or say 60%. Chances are there where it is too high, no one should expect like this will happen. So either way, just for example purpose, let's say for 40% of this will come, and the cost I need to incur for these kind of product would be $5K. Okay, then for minor, okay, then for minor the chances are like 10% of my goods return, and the happening of this is say 60% or something, and the spend which needs to be made for this is 1K only. So based on this, estimated value needs to arise based estimated value into the percent, the probability, estimated value for minor one into the probability. Okay, and then whatever is the average comes, the weighted average comes, will be your estimated value. So that needs to be recognized at the initial. Okay. Number three could be this one, discounted present value. Okay. Now this is something Now, one more thing, like all the recognition has to happen at the present value, okay? At the present value. So one of the situations for this is, say, dismantling cost, or decommissioning cost, or what we say, uh, to restore the environment. Okay, so you are doing some sort of mining in some areas. Okay, the companies of a mining company, and after the mining process is done, everything is done, then the land needs to be restored to its initial state, okay, as much as possible. Okay, so that incurs a cost. Okay, so the cost will happen 5 years down the line, but it is certain that company has to do it 5 years down the line, and the amount can also be, estimated. So yeah, so in that case, the cost which will be incurred 5 years later has to be discounted back, to present value. Okay, has to be discounted back to present value and then recorded. So yeah, so if I talk about the journal entry in this case, in the discount case, otherwise the journal entry is pretty much simple. You debit your expenditure, okay, which is you record your expense and you credit your provision. So first here let's take a blue one, debit P&L and credit provision. This is your expense, okay, provision. Now in the case of present value, this has to be recorded at the present value amount, okay, present value amount. Now subsequently what will happen, that this needs to be unwinded. Okay, it has to be unwinded. So next year it will be unwinded and the entry would be again debit your P&L and credit your provision. Okay, this is in for the expenses. Okay, now if you see, there is some dismantling cost required. Okay, which also happens in present value, because you have installed some machinery and all, and after the work is done you have to dismantle everything, wrap it up and move everything. So that is directly related to your machinery. So in that case, what you will record, instead of P&L, you will record property, plant and equipment. Okay, but subsequently when you are unwinding by the discount rate, by the discount rate which was used initially here, the same rate will be used for discount unwinding. So that will be recorded, and instead of P&L here, it will still be P&L, but it will be can be called as finance cost. Okay, so PPE initially and subsequently finance cost in case when it is directly attributable to a plant, property, plant or equipment. Okay, so yeah, this is how we measure initially and we do subsequent recognition. A few more things to touch upon, we'll just quickly cover that. So as part of subsequent recognition, let's take a black font here. Subsequent recognition, subsequent measurement, we can write. So subsequent measure, every year we need to review the provision. Okay, it needs to be reviewed. Okay, you need to review the provision. Okay, because you need to see if there is a material change in this, or the circumstances has changed, or the estimate has changed drastically, a significant change is there, then you need to revise the provision and give the possible effect. Okay, and if we need to also see if there's multiple provisions created, provision for depreciation which relates to PPE, provision for bad debts which relates to debtors, so and some other specific provisions. We see provision for warranty, provision for legal cases, so stuffs like that. So if we have specific provisions, we need to ensure that the provisions are utilized against the original expenses they are created. Okay, we'll take one example. We'll see how provision for depreciation is utilized, because I also got one request from one of my friend to just throw some light on the journal entries of the provision for depreciation and its impact. We'll look into it towards the end. And so yeah, this is how we see, subsequent we review it, and secondly we the provision will be utilized towards the original expense. Okay, yeah, so now this was the condition when these three conditions are satisfied, right? Which we discussed initially. These three conditions are satisfied, okay? The outflow of economic resources due to the past event, outflow is reliable and it is probable. What if the condition is not satisfied? What will happen then? In that case, we have to record a contingent liability, which we said we'll just touch upon that. So, contingent liability. So we can say it is like a possible obligation, not a probable. Possible obligation. So which is like less than 50%, where the possibility is there, but is not probable. So in that case, it falls under contingent liability. Okay. The one can be that it is uh, probable, like the obligation is probable, but cannot be measured reliably. It cannot be measured reliably. Okay. Cannot be measured. Excuse me for my bad handwriting because it's very difficult for me to write using a digital pen. I'm still learning this thing. So yeah. So in this case, we'll see if it is a contingent liability, and if it is a contingent liability, then we said it needs to be disclosed. Oops. 1 second. It needs to be disclosed. Disclosed where? Notes notes to accounts. Okay. So yeah, so let's see if we have missed out on any points here. An entity recognizes a provision. If it is probable outflow, economic resources will be required to settle provisions. We know this. An outflow is not probable, the item is treated as contingent. Okay. If it is not probable, it will be this. A provision is measured at the amount that the entity would rationally pay to settle the obligation at the end of the reporting period. Okay. Now once if this point comes, then also if you're not able to measure expense or your provision at the reporting date, but in the subsequent event, okay, before the final is counts is submitted, if you can then estimate it reliably, then also it has to be included as part of adjustments during the subsequent reporting period. Okay. Or if to transfer 1 second, to transfer to a third party at that time. Okay, so yeah, so what did it say? The provision is measured the amount that the entity would rationally pay to settle the obligation at the end of the reporting period, or to transfer. So either you pay or you transfer the it to a third party at that time. So risk and uncertainty is taken into account. We have talked about it, like the present value, the probability, right? So all those things are considered. A provision is discounted. So also we said that it is always going to be in present value. So we have covered this point. Future operating losses, you cannot record a provision. You cannot record a provision. Okay, because there is no obligation. There is no present obligation because of this is related to future operating losses, and you don't have any present obligation right now. You don't know, and nobody, wants to have this future losses. An onerous contract gives rise to a provision Onerous contract means you got into a contract, but now you see that contract is not hold doesn't hold good. So in that case, you will recognize a provision for that onerous contract. Okay. The provision for restructuring, you're making some changes in the organization. Okay, and that it will have some cost related to it. So you recognize that as a provision for restructuring and stuffs like that. So as we said, we'll just see the depreciation part, just one example of provision for depreciation. So we'll see now, say there is an asset. We'll just quickly wrap this up. So 1 second, let's take the blue one. So there is a fixed asset of costing, say, 100,000. This is the cost. The depreciation rate is, say, straightforward 10% SLM, straight line method. 10%. Okay, so now say the depreciation, the journal entry for depreciation is will be depreciation account debit. This goes to P&L and will credit provision for depreciation account. This goes to my balance sheet. Okay, asset side. Okay, so just this little provision for depreciation. Okay, PFD. Now, say for over the 2 years period, the depreciation which we have recorded is 20K dollar. 20K. This is for 2 years. Okay, first year, second year, both club. 2 years. Okay, don't get confused. Now, say in third year, in the beginning of the third year itself, we are selling this asset for, say, 85,000. Okay, so we will be creating a receivable. So a debtors account debit, say 90K. Then we will write off the machine, the fixed assets. So excuse me for my handwriting. Fixed assets account will get credited by how much was the closing balance? It will be this minus this depreciation amount. So leftover will be, or let's do it this way. Whatever it is recorded at 100. So we'll uh, I am saying something and I'm writing something. Credit 100K. Okay. Then I have to close this one as well. So we will debit provision for depreciation account. We will debit by how much? 20 is lying there. So we'll debit it by 20. If you see, debit total is how much? 110, right? 110 and credit is just 100. So what is the 10K extra? It is my profit. Profit on sale of fixed assets. Credit dollar 10,000. Now this also makes up 110. So this is how it will look like. So yep, thanks for watching my video, and please leave your feedback and let me know what is the next topic on which I should make the video.